Friends, thank you for being here today. What if I told you that the bedrock of the American economy, the residential housing market, is not merely in a bubble, but is actually the engine of a $23 trillion fraud that makes the 2008 financial crisis look like a minor accounting error? And how long can a system survive when the tax liabilities placed upon its citizens are mathematically impossible to pay? We are gathered here to confront a reality that is being meticulously hidden by a curtain of manipulated data, bureaucratic obfuscation, and a banking system that has chosen to extend and pretend rather than face the music of insolvency. We are staring down the barrel of a financial event so catastrophic that it threatens to reset the global economic order, a looming depression driven by a systemic property scam that has artificially inflated values, hidden toxic debt, and stripped the equity from the American middle class. To truly understand the magnitude of the crisis we face in 2025, we must first look past the daily fluctuations of mortgage rates and Zillow listings to the structural rot beneath the floorboards, a macro foundation built on systemic valuation fraud and debt overload. We are currently living inside a $23 trillion bubble of overvaluation. This figure is not hyperbolic. It is the mathematical disparity between what properties are actually worth in a functional economy and the inflated values assigned to them by central appraisal districts (CADs) and tax assessors across the nation. The fundamental disconnect lies in the definition of value. In a free and fair market, value is determined by what a willing buyer and a willing seller agree upon. However, this definition has been hijacked. Today, valuations are driven by algorithmic manipulation and administrative fire designed solely to maximize tax revenue. We are seeing homes that would struggle to sell for $200,000 on the open market being appraised at $1 million for tax purposes. This is not merely an administrative error. It is a calculated mechanism of equity stripping. By artificially inflating the value of the asset, the state justifies an exorbitant tax bill that acts as a second mortgage, a liability the homeowner never signed for, yet must pay under threat of foreclosure. The tragedy of this system is exposed when we look at the denominator of all economic health, the median household income. The terrifying reality is that the median household income in America simply does not exist to service the current level of debt. We have severed the tether between wages and cost of living. When you strip away the credit cards, the buy now, pay later schemes, and the refinancing loops, you are left with a population where approximately 37.8% of households are currently standing in the path of bankruptcy or foreclosure. These families are not just house poor, they are insolvent, kept afloat only by a banking system that refuses to process their failure because doing so would crystallize the losses on the bank's own balance sheet. But the fraud runs deeper than just inflated tax bills. It is anchored in what can only be described as the Ponzi structure of school district bond fraud. This is a $5.1 trillion shadow debt that hangs over the property market like a sword of Damocles. Across the country, school districts have engaged in the issuance of capital appreciation bonds, caps, and other toxic debt instruments. These entities are effectively behaving like the Federal Reserve, printing money by issuing debt against the future tax receipts of property owners. In 2024 alone, it is estimated that $450 billion was misappropriated through the fraud component of property taxes related to these bonds. This debt is toxic in the truest sense of the word. Studies dating back to 2015 identified these bonds as radioactive to the financial health of municipalities, yet the issuance has only accelerated. The mechanism is insidious. School districts borrow money today to build sprawling campuses and stadiums, agreeing to pay back massive sums of compound cumulative interest decades in the future. Because the districts have no revenue stream other than taxes, they must continually raise property value assessments to cover the escalating debt service. It is a closed loop of fraud, a Ponzi scheme, where the liability is transferred from the bank's end. The districts that created the debt onto the backs of taxpayers who never knowingly consented to this level of obligation. We have reached a point where the compound interest on these bonds is growing faster than the local economy's ability to generate wealth, making repayment mathematically impossible. While this macro fraud creates the conditions for collapse, we must also shine a light on the shadow housing crisis of concealed delinquencies and mortgage fraud that hides the trigger. If you look at official government statistics, you might be led to believe that the housing market is softening but stable. You might hear delinquency rates cited at a manageable 4%. This is a lie. It is a fabrication born from a culture of kick the can that has infected the Federal Housing Administration (FHA), the Department of Housing and Urban Development (HUD), and major loan services. We are witnessing a massive suppression of true delinquency rates since the pandemic, and continuing well into 2024 and 2025. The government has instituted endless workout programs. When a borrower stops paying, instead of initiating foreclosure, which would add that home to the supply inventory and lower prices the servicer grants a modification, they take the missed payments, tack them onto the back of the loan, and declare the borrower current. When the borrower misses payments again 6 months later, they do it again. This has birthed the 40-year mortgage trap. To lower monthly payments for insolvent borrowers, servicers are refinancing 30-year fixed loans into 40-year products. But here is the catch. These new loans often carry current market interest rates, which are significantly higher than the sub-3% rates of 2020 to 2021. The borrower is technically saved, but they now owe more money for a longer period at a higher rate. On an asset that is depreciating, they are essentially tenant serfs in their own homes, paying a fee to the bank to avoid eviction, with no hope of ever building equity. The zombie inventory is the direct result of this policy. Although the FHA foreclosure guardrails were officially lifted in late 2024, the bureaucratic machinery is clogged. There is a massive backlog of distressed inventory that has not yet hit the market. We know this because of the explosion in broker price opinions (BPOs). Banks order BPOs when they are preparing to foreclose. Real estate agents on the ground are reporting a tsunami of BPO requests for properties that are not yet listed for a sale. This is the water receding before the tidal wave. These homes are effectively already foreclosed. The paperwork just hasn't caught up to reality. When we dig into the granular data, the scope of the deception becomes clear. In specific markets like Aurora and Elgin, Illinois, a deep dive into multiple listing service and LS data reveals that serious delinquency rates defined as borrowers who have gone through multiple workouts or are months behind are not 4%, but are hovering between 18% and 20% in some distressed pockets. It is likely closer to 30%. This discrepancy between the official narrative and the street level reality is where the crash will originate. Furthermore, we are seeing a rise in sophisticated mortgage and occupancy fraud. Investors, desperate to find yield in a drying market, are defrauding the FHA First Look programs. These programs are designed to give owner-occupants priority bidding on foreclosed homes to stabilize neighborhoods instead. Investors are signing affidavits claiming they will live in the property, only to flip it months later or turn it into a rental. This crowds out legitimate families and artificially keeps prices high by introducing speculative capital into the low end of the market. Perhaps the most visceral element of this shadow crisis is the unlawful detainer epidemic. even. When a bank manages to foreclose, they often cannot secure the asset. We are seeing eviction timelines stretch to absurdity: 7 months in Baltimore, 120 to 180 days across Maryland, 90 days or more in Illinois. During this limbo, the occupants, whether former owners or professional squatters, often strip the home to the bone. They sell the copper, the appliances, the cabinets, and even the vacuums. When the bank finally takes possession, they do not have a sellable asset. They have a shell that requires tens of thousands of dollars in repairs. This destroys the collateral value backing the loan, further impairing the bank's balance sheet. While the systemic fraud described above provides the fuel, the spark has already been struck, leading us directly into a real-time market collapse in 2025. We are not predicting a crash. We are narrating a disaster in real time. The 2025 housing collapse is underway. Driven by a collision of three unstoppable forces: the collapse of affordability, the insurance crisis, and the investor exodus, affordability has not just eroded. It has been obliterated. With mortgage rates stubbornly holding above 7% and home prices artificially elevated by the lack of inventory flow, the monthly payment on a median-priced home in many cities has crossed the $4,000 threshold in a country where real wages have stagnated. This is a mathematical impossibility for the vast majority of families. The buyer pool has evaporated because the entry price to the American dream is now higher than the gross income of the average worker. Simultaneously, we are facing an insurance crisis that is turning homeownership into a liability. In states like Florida, the cost of insuring a home has detached from reality due to climate risks, litigation fraud, and reinsurance costs. Annual premiums are skyrocketing to $9,000, $15,000, and even $20,000 in coastal areas. This is a monthly cost equivalent to a second mortgage payment. But unlike a mortgage, it builds no equity and never ends. For retirees on fixed incomes, this is an eviction notice. They are being forced to sell because they cannot afford the insurance, flooding the market with inventory exactly when buyers are scarce. The third pillar of the collapse is the investor exodus during the pandemic boom. Wall Street firms, mom-and-pop flippers, and urban hosts flooded the market. They bought properties based on the assumption of infinite appreciation and endless rental demand. Both assumptions have failed. Rental yields are falling as recessionary pressures mount, and short-term rental vacancy rates are soaring, realizing that their passive income machines are now cash flow negative. These investors are rushing for the exits, but real estate is an illiquid asset. When everyone tries to sell at once, prices do not adjust gradually, they gap down. This collapse is not evenly distributed. It is concentrated in specific danger zones that serve as the canaries in the coal mine. Starting with the speculative deserts of Phoenix, Las Vegas, and Reno. Phoenix, Arizona, is ground zero for the 2025 crash. It was the poster child for the pandemic boom, fueled by buyers and speculative capital. Now, it is a graveyard of capital. Inventory in Phoenix has quadrupled, driving through the outskirts of Maricopa County. You see for sale signs on every block. Over 55% of listings currently feature price cuts. We see a different, but equally devastating dynamic playing out in the coastal insurance bubbles of Florida. Florida is facing a dual crisis of inventory and insurance in Cape Coral and Naples. Inventory has tripled. These markets were driven by retirees and remote workers seeking sunshine. Now, they are trapped by the insurance nightmare and new FEMA flood maps that mandate expensive renovati. The sunshine tax has become a literal tax that no one can afford. We are seeing a new migration pattern. Retirees fleeing Florida for Alabama, Tennessee, and the Carolinas. leaving behind a glut of unsellable condos and waterfront homes in places like Palm Bay. The speculative fervor has vanished entirely, with prices expected to collapse back to the $150,000 range. Finally, we must look at the tech hub busts in places like Austin and California. Austin, Texas, was the darling of the pandemic era, the new Silicon Valley. But the tech bro bubble has burst. As venture capital dries up and tech companies conduct mass layoffs, the high-income buyers that sustained Austin's $600,000 plus median prices are gone. Builders in the suburbs of Austin are panic selling, offering $100,000 incentives that completely destroy the resale value of existing homes in the neighborhood. Why would anyone buy a used home when the builder is practically giving away a new one down the street in California commuter towns like Stockton and Bakersfield? The story is similar. These towns boomed when people didn't have to commute to San Francisco or LA. Now, with hybrid work models requiring office presence, the 3-hour commute is no longer viable. These markets are heavily reliant on local wages, which simply cannot support half-million-dollar home prices. The collapse here will be swift and brutal. Moreover, we must recognize that this residential catastrophe is not occurring in a vacuum. It is inextricably linked to a parallel disaster that serves as the second pincer of this economic vice, the implosion of commercial real estate theory. Just as homeowners are drowning in artificial tax valuations, the commercial sector is facing a $2 trillion maturity wall of debt that is set to come due between 2025 and 2027. This debt was financed when interest rates were near zero. Refinancing it at today's rates of 7% or 8% is mathematically impossible for buildings that are sitting half-empty due to the remote work revolution. This creates a doom loop for the banking system, specifically the regional banks that hold approximately 70% of all commercial real estate loans in America. These are the same banks that provide the majority of residential mortgages as office towers in San Francisco and New York default. These banks are forced to hoard capital to cover their commercial losses, which means they stop lending to home buyers. It is a contagion effect where the sickness in the office market kills the residential market. But unlike 2008, where the risk was somewhat dispersed among global giants, this risk is concentrated in the very local institutions that form the backbone of the American economy. When these banks fail, and they will, as their collateral values plummet by 40% to 60%, the taxpayer will once again be on the hook, either through bailouts or through the silent theft of inflation as the Federal Reserve prints trillions to paper over the holes in the balance sheets. But beyond the cold calculus of banking solvency, there is a darker, more fundamental betrayal at the heart of this property scam, the erosion of private property rights themselves. We must ask ourselves the uncomfortable question: do you truly own your home? If you pay off your mortgage in full, holding the deed in your hand, but fail to pay the property tax, who takes the house? The state. In this light, the property tax system is revealed not as a contribution to civic order, but as a feudal rent paid to the government for the privilege of occupying the land you allegedly own. This system of equity stripping is a feature, not a bug. By artificially inflating assessments to service fraudulent bond debt, the state is actively confiscating the wealth of its citizens. It is a slow-motion foreclosure of the American middle class, transferring assets from families to the state and the financial institutions that service its debt. This is why investigations by bold officials, such as the probes into central appraisal districts, meet such fierce resistance from the administrative state. There is an entrenched bureaucracy that relies on this fraud for its very survival. The $23 trillion overvaluation is the collateral that keeps the municipal bond market alive. expose the fraud, and you bankrupt the local governments. Thus, we are locked in a struggle that is not just economic, but existential, a battle between a citizenry that demands transparency and ownership, and an administrative state that operates on obfuscation and rent-seeking. I want to pause here for a moment and hear from you. This idea that we are merely tenants on our own land paying rent to the government is a hard pill to swallow. Do you feel like you truly own your home, or are you just renting it from the state? Leave a comment below with your thoughts and experiences. I read as many as I can. So where does this all lead? We are moving past the point of a mere market correction and entering the endgame of insolvency and a potential Great Depression 2.0. The banking system is currently sitting on a time bomb. Banks are carrying trillions of dollars in impaired credit loans that are technically performing because of accounting tricks, but are practically dead. The collateral backing these loans, the homes and commercial buildings, is worth significantly less than the paper value of the loans. If we see a nationwide price correction of 40% to 60%, the banking system is technically insolvent. They do not have the capital reserves to absorb those losses. Compounding this is the refinancing wall. Between 2026 and 2028, trillions of dollars in commercial and residential debt will mature and need to be refinanced. These loans were written at 3% or 4% interest. They will need to be refinanced at 7% or 8%. Most properties simply do not generate enough cash flow to service that debt. This will lead to a liquidity freeze where credit stops flowing entirely, seizing the gears of the economy. This domestic crisis is unfolding against the backdrop of a global rebellion against the US dollar. Central banks around the world, specifically the BRICS nations, are buying gold at record levels. They are preparing for a de-dollarization event. They see the $34 trillion US national debt, the $23 trillion property bubble, and the unfunded liabilities. And they are voting with their feet. They are moving out of US treasuries and into hard assets. We are facing the potential for a currency re-evaluation. If the US dollar were to be re-pegged to reality measured against the M1, M2 money supply plus the massive debt loads, we could see gold revalue to shocking heights, potentially between $46,000 and $80,000 per ounce. This would represent a collapse in the purchasing power of the dollar that would wipe out the savings of the American middle class overnight. The trajectory we are on points toward Depression 2.0. This will not look like the 1930s with breadlines, but it will be characterized by a systemic failure of the credit system, high structural unemployment, and a breakdown of public services as municipalities go bankrupt. The Federal Reserve will be trapped. If they print money to bail out the system, they trigger hyperinflation. If they do not, the system collapses into deflationary ruin. Before we move to the potential solutions, if you are finding value in this deep dive analysis and want to stay ahead of this economic curve, please take a second to hit the like button and subscribe to the channel. It helps us get this crucial information out to more people who need to prepare. Is there a way out? The solutions are painful, radical, and necessary. We must consider the repeal of the property tax system, which has become a vehicle for a fraud and equity stripping, replacing it with a transparent uniform state sales tax. We must force school districts and municipalities to operate on a cash basis, banning them from the bond market to stop the Ponzi scheme of debt issuance. And perhaps most painfully, we must end the extend and pretend culture. We must allow the foreclosures to happen, allow the bad debt to clear, and allow prices to reset to a level that is actually supported by American wages. The alternative is to continue the lie until the weight of the fraud brings down the entire house. The storm is no longer on the horizon, friends. It is at the door. The $23 trillion bill is coming due, and America is about to find out that it has insufficient funds. Thank you.